In 2021, AMC Entertainment's shares experienced tremendous growth. It attracted a group of traders who urged one another to buy and keep AMC shares regardless of what they read or heard in an effort to short squeeze those who were pessimistic about the company's future. While this was going on, AMC's actual business struggled throughout much of the year to recover from the destruction the pandemic brought to its theater chain operations. Here are some explanations as to why investors should avoid AMC stock in 2022. What's good, you guys? This is Market Thrive, and today we're going to be talking about AMC's stock crash and the reason why you should sell their stocks right away. Before I start the video, I would just like you to do me a favor by just hitting that subscribe button and the bell notification down below to keep you updated on this channel. So without further ado, let's hop into it. The first reason to sell their stocks is that AMC stock is too expensive. AMC's stock is still trading up about 1,300% for the year after sliding nearly 60% from 52-week highs reached earlier in the year due to the short squeeze price increase. The rise was mostly unrelated to an expanding business. The number of visitors to AMC theaters was essentially unchanged from the prior year during the 9 months that concluded on September 30. Instead, a handful of retail traders' continuing support was the main factor for the stock price growth. Through 9 months of this year, AMC has lost $1.2 billion in revenue, and the company has little chance of turning things around anytime soon. The disruptions caused by a potentially fatal virus in circulation, on top of the company's difficulties operating profitably regularly even before the pandemic, severely decrease its chances. Some AMC managers are selling their shares, which may be another proof that the company is expensive. The other reason is that it's a declining industry. Even before COVID-19 broke out, the movie theater sector had been experiencing a long-term downturn. Stakeholders took a while to adjust to shifting customer tastes. Movie theaters have probably had the least amount of innovation over the past 20 years of any sector. The experience has largely not changed, although movie tickets have become more expensive. The average price of a movie ticket in the United States increased from $5.66 in 2001 to $9.37 in 2020, not including increases in 2021. That helps to explain why the number of movie tickets sold has decreased over time from 1.48 billion in 2001 to 1.24 billion in 2019. Unless the movie theater industry can enhance the customer value offer, the trend is unlikely to change. When the pandemic first started, AMC management performed a fantastic job of obtaining enough cash to guarantee the business survived until it could reopen. At that time, its cinemas were closed to the general public. AMC's balance sheet is now in jeopardy as a result of the measures taken to raise some cash. The corporation owes $5.4 billion in long-term debt, which results in annual interest costs of hundreds of millions of dollars. Additionally, it's doubtful that AMC will have enough cash on hand when the main payments are due to be paid. It intends to restructure the debt. AMC has $1.6 billion in cash on hand as of the third quarter, which concluded on September 30. The number will probably keep decreasing. AMC experienced a $114 million cash from operations loss in quarter 3. In conclusion, AMC's business prospects are dim both now and in the future. The balance sheet has a risky amount of debt. The stock price is so inflated that AMC will have a hard time defending the high price with increased earnings. If you currently own shares of AMC, this would be a great moment to sell them since prudent investors will steer clear of this stock. AMC's shares fell by about 42%, adding to a loss of more than 26% from the previous week. The AMC's new preferred shares were probably a big factor in the drop. The decline also occurs after rival Cineworld said on Monday that it is thinking about declaring bankruptcy. AMC CEO Adam Aron said in a statement that the firm was very enthusiastic about films coming out in the fourth quarter and in 2023 after Cineworld last week issued a warning about its financial position. The US box office is still well below its pre-pandemic levels even though 2022 has produced large box office successes like Gun Maverick, and studio executives have expressed a willingness in turning back to theaters rather than streaming-only films. At the end of the second quarter, AMC reported long-term debt of more than $5 billion. When lease obligations and other long-term liabilities are included, the sum exceeds $10 billion. AMC's stock has recently fallen, and Bed Bath & Beyond's shares recently reversed course sharply. Both names have become into meme stocks with substantial social media followings, and retail investor participation. After activist investor Ryan Cohen said that he had sold all of his stock in the company, Bed Bath & Beyond's share price dropped more than 40% on Friday. On May 27, Gun Maverick was released, and as of August 14, its worldwide box office earnings had reached $1.37 billion. Memorial Day weekend and all of June's income from Gun Maverick showings at its sites were included in AMC Entertainment Holdings Q2 2022 earnings. And once again, they failed to produce a profit. Stop being so fixated on AMC stock. Blockbuster films like Maverick, which recently overtook Titanic to become the 7th highest grossing movie of all time, only appear once in a blue moon. I'm not saying AMC is going bankrupt, but it is a losing business that can't even make money when one of the biggest movies ever is playing in its cinemas. I believe AMC is grossly overvalued. They will need to raise capital over the course of the next year, and it appears unlikely that they will ever reach a point of continuous profitability. Take a step back and review the financials of AMC, all you investors with the mentality of diamond hands. A short squeeze is likely given that the short interest is currently around 18.45% according to Seeking Alpha, but AMC doesn't appear promising as a long-term investment because additional dilution is all but certain. The CEO of AMC used to brag about the war chest of cash that AMC had on its balance sheet. The cash position of AMC has decreased by negative $846 million during the preceding year. On its balance sheet, there are additional issues. If business KPIs don't improve, or if AMC doesn't commit to a capital raise, it will take the company 5 to 6 quarters to exhaust its remaining cash at this rate. AMC's total assets have decreased since Q4 2019. AMC's total assets were $13.68 billion when it was last reported, a decrease of 28%. AMC's total equity has decreased by negative $3 billion since the fourth quarter of 2019 as a result of the dropping assets. AMC currently has negative book value and negative equity on its books of $2.33 billion. AMC has never been profitable on this criteria over the preceding 11 years when the intangible assets are removed and the tangible book value is examined. The tangible book value of an AMC share is $9.49. AMC has a $10.46 billion debt load overall, a falling cash position, negative equity, negative book value, and dwindling assets. The only way I can see AMC surviving is by issuing shares and raising money because they don't make a profit. AMC's business strategy hasn't demonstrated that it can provide stable profits, and its high operating costs make it challenging to at least break even. So how long do you guys think it will last? If you like today's content, you'll sure love our previous video about Bed Bath & Beyond and the reason why their market crashed, which you can find in the description below. Feel free to jot down your thoughts in the comment section below. If you enjoyed today's video, please leave a like. And if you want to stay updated on our posts, hit that subscribe button as well. Once again, this is Market Thrive, signing off.